Hi everyone, welcome to a new video. In this video, we are going to be studying derivatives and the basics of derivatives and a bit about forwards versus options. Forwards and options are the two most popularly used derivatives. So we're just going to see the basic differences between forwards and options in this video. Now, first of all, what is a derivative? Define a derivative. A derivative is a security that derives its value from the value of the underlying asset. Now, a derivative on its own does not have any value. A derivative is something that will always derive its value from that of the underlying asset. And what could the underlying asset be? Now, there could be various types of underlying assets. Some examples I've listed here. For example, you could have equity shares, equity market index. Equity market index could be the Nifty market index in India or the S&P 500. You could have a commodity, which could be the underlying asset, interest rates, currencies, weather. Weather is also a recently used underlying asset for derivative contracts for trading in derivatives. Now, the two main types of derivatives are forwards and options. So first we'll see what is a forward contract. Now, a forward contract is a contract to buy or sell at a future price. Very simple, you are just contracting today. You are saying that I will buy X asset at so and so date in the future at this price. You are just agreeing to enter into a particular contract, agreeing to buy something, sell something, agreeing to contract at a particular future date, and that contract you are making today. You are not buying or selling the underlying today. You are agreeing and contracting to buy or sell in the future date, and that is a forward contract. Now, a future, you have futures which are traded on the exchange. So a future is nothing but an exchange traded forward contract. When a forward contract is listed on an exchange, that is a future contract. Now let's see an example of a forward contract. For example, if you enter into a contract to buy 10 Apple shares at $215 per share 1 month from today, and we are denoting 1 month from today as T1. Now, this is the example. The example is you have contracted today to buy 10 Apple shares at $215 per share 1 month from today. Now, in this example, what are the different factors in this example? These are listed below if you see. Now, first of all, Apple share, that is the underlying asset. Your derivative contract is to buy 10 Apple shares. So the underlying asset here is the 10 Apple shares. The contract price is $215. That is the forward price, the price at which you will exercise your contract in the future. T1, that is 1 month from today, that is your settlement date. On that day, you will close the contract, you will exercise the contract, or you will carry out the contract. The contract size is 10 Apple shares. So if you go to the futures contracts also, if you look at the futures contracts that trade on the exchange, you will always have a lot size, a contract size. You will never have one equity share. You will have a lot of 100,000 and so on. So in this example, 10 Apple shares is the contract size. Now, there could be two scenarios. I've discussed two scenarios in the last 2 points. If you see, if the spot price is the price today. Now, at T1, that is 1 month from today, if the spot price at that point is $220, then what will you have? Will you have a profit or a loss? So try to understand here. We have contracted to buy 10 Apple shares at 215 per share. If the spot price at T1 is 220, then I can purchase the 10 Apple shares from the forward contract at 215 per share, and I can sell them in the spot market at 220 per share, which allows me to earn a profit of $5 per share. So I will have a profit of $5 per share into 10 shares. So I will have a profit of $50. Now, example 2, if the spot price at T1 is $200. Now, from this contract, since I have entered into a forward contract, I have to buy the 10 Apple shares. I don't have an option to not buy it. I have to buy the shares. So I will have to buy the shares at $215 per share, and I will be able to sell them in the spot market on that day only at 200 per share. So I will have a loss per share of 15 per dollar or $15. So that will make me a loss of $150 in total. So if you have to just summarize this, when you enter into a forward contract to buy, here we've contracted to buy at 215. So if the price in the market is about 215, So we will be able to sell at a price about 215. So that will mean that we will be able to earn a profit. But if the price in the market, if the spot price in the market is below 215, then we will make a loss because we will have to buy at 215 through this forward contract. But we will be able to sell only at less than 215, which will mean we will incur a loss from this contract. Now the next thing, the difference between forwards and options. Now, what is an option? An option is the right to buy or sell at a future price, but not the obligation. Now, in a forward contract, if you would have seen, we had contracted to buy. Even if the end result, even if the spot market is so it's irrespective of the spot market price. Actually, if you see in our previous example that we saw, we had seen that we had entered into a contract to buy the share of Apple at 215 per share, irrespective of what the price in the spot market is, whether it is 210, 220, 230, 200, we have to carry out the contract. But such is not the case in an option contract. In an option contract, you have the right to buy or sell at the future price, but not the obligation. So we will understand it through this example. Now here, if you see, for example, the right to buy 10 Apple shares at 215 per share 1 month from today. So I have kept the example very similar, but here you only have the right, you don't have the obligation. You've not contracted to buy it, you only purchase the right to buy. The wordings are very important. Now again, the Apple share is the underlying asset. 215 per share is the exercise price. T1 is the settlement date, and 10 Apple shares is the contract size. Now, in an ideal scenario, this is a very important point. In an ideal scenario, everyone would enter into options contracts and not forward contracts, since the end result will always be profits or no losses. Now, why do we say this? Because in an option contract, we say we have the right but not the obligation. So let us say here, now I have to buy. Now this contract allows me the option to buy the share at 215 per share in the future. Now, if the price is more than 215 in the spot market, the price is more than 215. I will buy it through this. Options contract. I will buy the share and I will sell it in the market at the higher spot price, so I will earn a profit. But if the price is below 215, then I would be able to purchase through this options contract at 215, but I would be able to sell at only less than 215, so that would make me a loss, like we saw in the previous example also. So in those cases, I would not exercise the option contract because I have the right but not the obligation. So in an ideal scenario, everyone would enter into options contracts because you will always have profits and you will never have losses. You will always be able to avoid losses by not exercising the contract, since you only have the right but not the obligation. So let's read this point again. In an ideal scenario, everyone would enter into options contracts and not forward contracts, since the end result will always be profits or no losses. But this won't happen, since at inception of contract, the option buyer has to pay a premium, which is called the option premium. There is no such money exchange in a forward contract at inception of contract. So in a forward, there is no exchange of money at the inception. At day one, there is no exchange of money. Whatever exchange of money happens, that happens on the expiration date, on the date of settlement of the contract. But in an options contract, to be able to have the right to buy or sell, to be able to decide whether you want to exercise the contract or not, to not have the obligation but only have the right, to be able to have this advantage, you have to pay a premium for this, and that is called the option premium. So that is a cost to an options contract. There is no such cost in a forwards or a futures contract, but in an options contract, you will always have an option premium that you will have to pay. So let us see the example here. Let us assume an option premium of $1 per share in this example. So total option premium payable at inception will be equal to $1 into 10 Apple shares, so it is $10 in total. Now let's say if spot price at T1 is 220, so you have the right to buy at 215, you will be able to sell at 220, which is the spot price, so you will be able to make a profit of $5 per share, that is 5 into 10, $50. But you have also paid the option premium at inception, which was $10. So your net profit is only $40. So option premium you will always have to deduct to arrive at the net profit or loss that you have derived from the options contract. Now, if the other example, if the spot price at T1 is $200, you will not exercise the option since it would result in a loss. You are not going to buy the share at 215 when you can buy it from the market at 200 itself, or you are not going to buy it at 215 and sell at 200 and incur a $15 loss. You're not going to do that. When you can buy from the market at a cheaper price, you will simply not exchange the options contract. However, you will still have a loss because you have paid the option premium at inception to enter into this options contract. So, however, $10 option premium paid at inception of contract would be the total loss on this contract. So I hope you have a basic understanding of forwards and options and the key difference between forwards and options. We will be discussing more about forwards and options in our future videos. Thank you for watching.